All right, good morning, everybody. Mike Courtney here, Mass Mutual, Eastern Pennsylvania. It is a beautiful, crisp fall morning here in Eastern PA. And I'm joined, as always, by my good buddy and counterpart, Steve Parisi, President and CEO of IBC Global. Steve, good morning, good day. How are you?
Morning, Mike. Fantastic over here. Thank you for asking, and always a pleasure to talk all things cash value life insurance with you. Right on.
So today, there's a couple of things we want to talk about today. One is, what happens when your typical solution, not that there is a typical solution, but if you have to go off the path, or maybe if something's not the right fit. I mean, you have to run into the cases now and then where cash accumulation, whole life policy might not make sense.
Correct.
I can think of a couple of scenarios that you and I have been involved in where somebody was really biting off more than they could chew, or getting involved in something that they didn't really fully understand. But that's not really what we're talking about here. We're talking about something where maybe there's another solution that's going to work better. So I'm sure that's something that comes up, right?
Yeah, absolutely. And we had a recent case, actually. We get them on occasion, but a recent one where someone was looking at a large dollar amount. It was between $250,000 and up to $400,000. They wanted to move into a policy very, very quickly and then be able to access that money within a few months for a real estate purchase, because they've done well in their real estate investments. They know exactly what they're doing. Like, that's their moneymaker. They're almost retired as well. So once they retire, they'll just be focusing on real estate. But they like the idea of a cash value life insurance policy where I can pump money into the product, continues to compound when I borrow against it, like a line of credit, all of that fun stuff. But looking at the numbers and having a conversation with them, it didn't really make sense. We hit on some points just to clarify how the product worked. But just to kind of back up before I get into all of the details, or we talk through the details, when I looked at that situation, and when I look at any situation, what I'll ask myself first before saying anything to the prospect or client is, if this was me, would I want it? With the particular situation that they have, the dollar amount, how they want to pull the money out quickly, if this was me, would I do this? Yes or no, right? Immediate reaction, just knowing the product inside and out, not try to justify it. Well, if you do this, like, if it was me, would I want to do it the way that they're considering doing it? And their situation was a no for me, and it still is. And the reason why is there's a lot to it. But before we look at the loan feature of the policy, what they wanted to do was take a lump sum of money, at least $250,000 initially, and move it into a life insurance policy. And then have the ability to borrow against the payment they just made, call it $200,000 for real estate. But before we talked about borrowing, the husband made a comment. He said, okay, my understanding with this, Steve, is that I can pay this $250,000 into a policy, and if the dividend rate is over 5.5% or 6%, that's what my money's growing by, right? And right there, it's like, good question. A lot of people do feel that you put that you put money into a policy and earn the dividend. However, that dividend rate is always applied to your cash value after the insurance company takes out all of their insurance expenses and everything that comes with the life insurance policy. So, year one, you paid in $250. Your cash value was $215, $220, whatever it was. What do you see there? Well, if I paid in $250 and I've got $220, it's a loss of $30,000.
That doesn't sound like a 6%.
No. And the thing is, like, when you and I see that on an illustration, we often think, okay, people are aware of that because that's the first thing I see as far as that negative hit on my money.
Right.
But just having a conversation, talking through that point, not assuming that he and his wife understand that and understand it as well as I do, is like, we don't want to assume that people know every detail. Take your time and go through things how you like it when people take their time and go through things with you when you're trying to learn about it. So hit on that, and he goes, okay, Then we looked at the next year. The IRR was like almost flat at 0% or slightly negative. And it picked up each year. But if we even looked at, say year 4, if the IRR is 2% that particular year, if he's borrowing against it at 5%, it's a negative 3% spread. Not what he thought as far as earning the dividend rate of almost 6%. Okay, I can earn 6%, borrow at 5, it's a positive spread. It's like, no. On paper, it looks like that, but in reality, it's not. We've got to look at the net growth rate, the net internal rate of return, especially if you're looking to take out max loans. If you're not taking max loans, I like to look at what's the actual dollar amount the policy is growing by. How much did I receive in total dividends and guaranteed interest from the insurance company? And then how much did I pay in interest? Then I can see, did I get more money or did I pay more money? Like, which one's easier to look at?
So like that person in particular, what do you end up talking to him about?
Yeah. So we recommended that the strategy he wanted to move forward with was not a good idea. And he agreed with that. He kind of mentioned it himself first, just as he was talking to himself and we're talking through it. It's like, I don't know if this really makes sense. I'm like, it doesn't. Just as we're going through the numbers. When it does make sense, Mr. Client, is when we look at the IRR and the cash value growth after a few years with what you want to do with the maximum loans. Here's what the numbers would look like. He goes, okay, that I can justify, but I've got this big deal coming up within the next few months that I need this money for. So, I mean, down the road doesn't help me. So I'm like, all right, well, what I would do then, if we flip positions, here's exactly what I'd like to progress through, is I would not try and force this policy to work, because if you feel like it's a burden, in addition to seeing the numbers not working, you're going to be stressed out over it. And it's always ugly, almost always ugly in those situations. What I would do is perhaps look at a smaller policy where you can start with a lower dollar amount, build it up, and then in a few years, you can easily use it for other deals. Or you can start a large policy in a couple of years, or perhaps after this next investment pays you back the money you're expecting, then go all in. But the answer to
so hard for a consumer to flip from short term to long term.
It is.
Yeah.
Yeah. And I mean, I let people know too, like you can access, if you've got 220 grand that you've got available in cash value in the first year, you can access that. That is your money, and people we work with do access it.
Right.
But the main thing I just like to make people aware of is the fact that I might have 220, but I paid in 250, so I've got that negative hit. And why I lean into that point is where people have buyer's remorse, is finding out after the fact that, okay, this is not what I thought it was. I wish someone would have told me that, whether it's a small item or big items. It's little things like that just feel like a thorn in someone's side. Like, wait, so-and-so didn't tell me this kind of stuff. It's like, just take your time and go through it and get the hard part, the negative stuff out of the way first. And then it makes life easier for everyone, especially the consumer, which the focus is on them.
Do you ever find yourself or some of your downline agents getting so wrapped up or focused on like the ultimate goal strategy that it's hard to pull away and go in different directions? Meaning, sometimes you're probably working on a case that doesn't have one big solution, has a couple of different solutions maybe that are the best fit, but you get so laser focused on like, maximize cash value or best IRR or whatever it is.
Yeah, that happens quite a bit. So what I like to do in that case, because our agents, and I've been guilty of this too, sometimes we go back to what we're used to, what we're very good at, which is what you just mentioned. How do I maximize the cash value? What's the internal rate of return, IRR compared to the loan rate, all that fun, cool stuff about life insurance policies. And yeah, I'm a nerd as I hear myself say that. But if someone's asking questions or has a different objective, the most important thing to do in that situation is listen to the individual and listen to things very, very closely, and then model the plan or model the solution or strategy around what they want, not what you're used to. And if you don't know, say, hey, that's a good question. I haven't dealt with that before, but someone else in my office has. Let me touch base with them. Can I tie them into this call, or we can connect later today at another time that works well for you? This is not my area of expertise. Like, you've got to be okay saying that, and you've got to have the confidence too that if I say that, okay, the person might lose some confidence in me with what they want to do, but we are going to take care of them. Don't try and pretend to be something that you're not, because that's where problems pop up.
Yeah.
Yeah.
What about, we were talking earlier about something that I was always really frustrated with is the folks, whether it's client or the advisor, where it's like, if I've got a lump sum that I want to get into some kind of cash accumulation vehicle, and sometimes that total amount doesn't work, whether it's product limitations or mech limitations. And a lot of times I've found the person on the other line that I'm talking to is like, wow, this isn't going to work then, you know?
Well,
And I never understood that. It's like, well, conceptually, this is a good idea. So, like, I think it's a good idea, whether it's $100,000 of premium or $10,000 of premium. And, it just might mean a little more slow and steady in the early years, as opposed to like a big lump sum. Do you guys ever struggle with that?
Um, I used to quite a bit. So a situation, as an example, someone's got $500,000 in cash. They want to move it into a policy, but they want to get it into a policy in 1 year. I want to move it all into the policy in the first year, which requires a high death benefit from a mech limit standpoint that they might not qualify for. The underwriter says no way, and no insurance company will do that. No matter how much they can't afford it. There's times it's just not going to happen. So in a case like that, from the consumer's perspective, they're thinking, what's wrong with this insurance company? I've got $500,000 here. Do they not want my money?
They don't want my money.
Correct. But the underwriter's thinking, why is the agent telling them that they can do something that, based on our financial guidelines, is not allowed? We're not going to allow it. So you've got this friction occurring all over the place. So in a case like that, I have seen where clients say, well, if I can't do it this way, I'm out. Like, I'm not going to do it. And I get it. Like, it's always up to the consumer. We're going to accommodate to them.
Yep.
But what I'll look at here is, if you've got a lump sum of $500,000 up front, this is from experience, I'll let them know, okay, based on your income, financials, it might be difficult just based on guidelines that the insurance companies have. I can share those with you, no problem. But it might be difficult to get the full $500,000 into the policy. With that said, I can show you how to break that up over 2 years, which we can actually do over 6 months if we do things right, and get it into the policy very quickly. And the performance will actually look a little bit stronger too when we look at the cash value. Would that be something you're interested in seeing, or that's something you don't want to entertain? Ask that question first. Don't force it on them, because if I force it on you, where your mindset is, I'm paying this all in one shot, but then I show you something else, no good. If I ask you, is it okay if I show you this and you can see the difference in performance and such? All right, yeah, I'll take a look. And then they'll see the numbers. And this is from a design perspective, how we'll set it up, to look at it. And then you get that, I like that one a little bit more. I've got more money there. So now all of a sudden you've completely overcome the problem there, just with having knowledge on, call it design, and then asking the client if they'd like to see it first and let them decide. And if they're still stuck on option one, that's okay. Just let them know we'll push for it, and we'll let you know the maximum we can get, but it might be closer to option two. Just be upfront.
I always found it interesting, like, as a consumer, I feel like if I had a goal of, $5,000 a month into, pick a vehicle, and for whatever reason, somebody came back to me and said, you know what, we can do this, but you can only do $2,500 a month. I think I would just be like, all right, well, I've got $2,500 a month left over that
Yeah.
do something else with, or
Yeah.
do this again, or, I never, it was always like, I always felt like it was like a quick
Yeah.
reaction of like, wow, this isn't going to work then. It always surprised me. that's a lot of times the mentality.
Yeah, I do
I
get
think
it.
people are so focused on like max funding, maximize everything, you know.
I agree with that. Yeah. We had a recent case. It was a smaller amount. Young guy. He lives in New York, right? So life insurance in the state of New York is challenging just based on the guidelines there, extremely strict compared to all other states. He wanted to pay in $30,000 per year into a policy with Mass Mutual. Could easily afford it based on his earned income, other sources of income he had, no problem at all. And the base premium was $3,000, so a lot of flexibility, like very, very easy. However, based on New York State guidelines, Mass Mutual was stuck on $20,000, and they were not budging no matter how many favors we tried to pull. Like, it was stuck because of New York State guidelines. So communicated everything with the client, went over details, the policy strategy, and what he ended up doing is first what you just mentioned, said, okay, if the max I can do with Mass Mutual, like I want to do this, if it's 20K, I'll do that. From an alternative, I still want to get a total of 30K into the policy. What do I do? So what we did there was take out a separate policy with Guardian, where his minimum commitment is about $1,000 with a term rider. It's $1,300 per year, and he can pay up to $10,000 per year. So now from an affordability standpoint, it's still very easy for him. The Guardian one, he's doing 10K per year, but he's committed to a minimal amount that doesn't hurt him at all. So you can still do it. It's just having different options available and not just saying, here's a good idea, here's the alternative. Like, okay, here's what we ran into. Here's what it looks like if we just take this. Would you still like to try and get the 30K in? Yes, I would. Well, here's an alternative. Here it is compared to the original option, all with Mass Mutual. Now we've got option B, everything side by side, so they can still see it instead of feeling, okay, I'll just do it because I wanted to do it originally. And then they come back to you later and say, this is different than what I wanted. It's like, no, let's get it all up front, invest the time, and then we've got a satisfied outcome at the end of the day.
I guess at the end of the day, shameless promotion for Mike and Steve. For any brokers listening out there, I mean, we do have the experience of working through, hundreds, if not thousands of these types of cases and clients and concerns and issues. So sometimes it is a little bit easier, for us to kind of navigate or tiptoe through these scenarios and still have a good conclusion as opposed to just, kind of getting stuck in the mud.
Yeah, fully agree. Thank you for that.
Yeah. So if anybody's interested in anything that we were talking about today or anything that we've talked about on any of our podcast discussions, feel free to reach out to me, Mike Courtney. I'm brokerage director with Mass Mutual, Eastern Pennsylvania, or my counterpart here is Steve Parisi. He's the president and CEO of IBC Global. And we look forward to hearing from you. And thanks for listening. Steve, have a great day.
You too. Thanks so much, Mike. Enjoy.